Today I want to go through one of the functions that's found in the TD Ameritrade Thinkorswim platform. Just show you how creative you can get with it. What I'm showing you right here is the website for TD Ameritrade. It's a bit confusing sometimes because they have a web-based platform right here. And then they also have mobile trading on your phone. And then they have something called Thinkorswim. And this Thinkorswim desktop, the reason why it's a bit confusing is this is a platform that TD Ameritrade acquired from the guys over at Tasty Trade. So they actually built the platform and TD Ameritrade bought them over. And now Tasty Trade has built their own platform to compete with them called Tasty Works. So this platform runs on its own. So what I'm going to do is walk you through just one of the functions. Just for those of you who don't know, I'm called Uncle Dan. I've been trading for more than 3 decades, and I just really like helping people understand how to use financial tools to be successful investing. It doesn't mean guaranteed to make money. We're going to move over to the Thinkorswim platform. Okay, guys, top of mind right now, Tesla's making all-time new highs, and I'm thinking about buying calls, as crazy as that sounds. Question is, do I go short term or long term? And what happens to the Greeks when you go short term or long term? And a lot of people are struggling to get their head around this. We know that if we buy a short dated option, the theta decay is really high and we'll lose money every day. And so we're told if we go longer term that theta decay will be less, but how much less? And then what I'm trying to explain to people is implied volatility is really important when you go further out. In other words, you don't want to pay too much for an option further out. Okay, so there's the concept. I don't want to go beyond that because I don't want this to be a 2-hour video. I just want us to take one little piece of information and just digest that for a day. And then we can talk about something else. So that's what I want to talk about today. I want to buy a Tesla call because that's absolutely the wrong thing you should do at an all-time high. But now I'm worried about implied volatility affecting my option price. So let me walk you through this. And there's obviously a lot more complexity around all of this stuff, but if I can just get you to grasp a simple concept of visualizing how the Greeks affect short-dated versus long-dated, that's all I want you to get out of this. Okay, I'm not going to talk about the formula. I just want you to visualize, like, why would I do a longer dated option, and why does Uncle Dan tell me don't pay too much for a long dated option if the implied volatility is high? And then why am I emphasizing to find low volatility options that are further out? So here are the Tesla 2000 calls. Okay, the market's closed up 185 points. It's actually trading higher. We want to buy a 2000 call, but we need to understand the Greeks. Okay, so there's delta, theta, implied volatility, and then I've added Vega in here. Okay, so I'll explain really basically what they do, and then I want to talk about how they're different depending upon how far out you go. So delta tells you how much this option, which the 2000 call that expires in 4 days, is priced at $22. Okay, so that $22 option has a delta of 0.22, which means the price is going to move 22 cents for every dollar move in Tesla. 0.2 means it's going to move about a fifth as much as the stock. So if the stock moves up $1, this is going to move up 22 cents, as an example. Think of it like that. Now, what happens if I go out to January and I want to do a call? I'm going to pay more for the call. Instead of $20, it's going to cost me $300 in January. All right? So $300 instead of $20. Concept is short dated versus long dated. How are the Greeks different? Because if you can understand how those two are different, then you'll understand what's going to happen to your longer term Greek as you get closer to expiry. Give me a thumbs up if by the time we're done here you think I've helped you. If I haven't, give me a thumbs down and I'll just delete the video. Focus. Delta. A 1 week option has a delta of 0.22. That means if the stock's $1, the option's going to move 22 cents. Okay? Longer dated option. If the stock moves $1, the option is going to move 52 cents. So when we go further out, if we think the stock's going to go up, it's the longer dated option that's going to move more than the short dated option. Okay? So I just want you to think of it like that. If I buy a longer dated option at the same strike of 2000, the movement of that option will be more for an out of the money option. And you know, the stock's at 1840, we're talking about an out of the money option. So when we look at this, the out of the money option in January is going to have a delta of 0.52. So it's going to move more. So if you're bullish the stock, you should buy a longer dated option. But here's the problem with that. Longer dated option is going to cost $300. The shorter dated option is for $20. Long dated is $300, the short dated is $20. So obviously you'd like to pay $20 instead of $300. So you got to balance the two out. Are you comfortable only making 22 cents on the dollar for a short dated option versus a long dated option? So you have to decide whether you're willing to accept it. Now, everyone knows if you buy a short dated option, theta decay is going to be really hard on you. We know that because everyone tells you that. That's what everyone tells you. And you know that when you buy an option, you hold it for a week, if the stock goes sideways and it's an out of the money call, it goes to zero. So you know you're going to lose money on there. But how much money you're going to lose? So theta tells you how much time decay you're going to have each day. Okay? So I'm going to lose $5.54 on my $20 option. That's 25% of the value is going to drop in the next one day because I only have 4 days to expiry. You understand? So I'm going to lose 25% tomorrow on this call option if the stock goes sideways. That's crazy, right? It makes it really hard to try to recover that money. What happens if I go out to January? What's my theta decay? Because I still have theta decay because I'm long an option. What's my theta decay? We go out to January, it's $1.15 when it's longer dated versus shorter dated. So that's all I want you to know. I want you to know that shorter date options, the theta decay is 5 times as much as a long dated option. That's all I want you to know. Now let's look at the implied volatility. Usually implied volatility is higher close to expiry, and it usually goes down when you go further out. And that's fairly normal. That's a normal vol skew. Vols go down a little bit. It doesn't mean the price goes down. It means the implied volatility goes down. And we can see here, this is the bid and the ask price. You can see on the bid side, the January is bid at $283, and the August 21st is bid $22. So the price is different, but how do we know whether they're cheap or expensive to each other? And the way we do that is by calculating implied volatility. So the implied volatility allows us to compare these. So when you look here, the implied volatility is telling you, hey, this $283 option is cheaper than the one in August. So like for like, it's cheaper, but the price is more. Why is it cheaper? It's because of the amount of time you have, because of the delta, right? So all the parameters rolled up, time, the strike price versus the stock price. That's all you need to know. What you need to know is normally vols are lower further out, and then they go up. Now, why do I tell you only buy long dated options with low volatility? You know, I've learned this over time by actually trading. A lot of people won't teach you this stuff in a book. Look at my Vega. Now my Vega tells you how much my stock price moves with the change in my implied volatility. So what it tells you here is that if the volatility goes up by $1 or 1%, my Vega impact on the price is around 0.63. So don't worry about the specifics of the percentages and the parameters. Just keep it at a very basic level. Your Vega is 0.63, whatever that means. So when volatility goes up in there, you're going to make 0.63 of the volatility move. Likewise, when volatility goes down, you're going to lose if volatility goes down. So here's your theta decay, okay? So over time you have theta decay and you're losing, but what if volatility drops? Theta decay is just assuming volatility remains the same. What happens if volatility drops? Your Vega will tell you how much you're going to lose from a volatility drop. So why do I tell you to always get a cheap implied volatility call option when it goes further out is because let's look at the Vega. The Vega is almost 5. Okay, so the Vega is 10 times bigger than the Vega on a 1-week option. So what does this mean? This means that if volatility drops out here, you're going to lose 10 times as much. So let's turn that around. What happens if the volatility is really low further out and the volatility jumps up? The volatility jumps up, you're going to make 10 times as much versus a short dated. So that's the basic concept I want to try to get across. If the volatility goes up in a longer dated option, your premium is going to go through the roof because of the Vega. The opposite side of that coin is if you pay too much vol for a long dated option and the volatility drops in that long dated option, you're going to get killed because of the Vega. Right? So that's the difference. When you go longer term, your theta is really low, -1. So you're only losing $1 a day versus $5 a day. Right? Your delta is higher, so your option moves more with the underlying. But your Vega's high, and that's got to be, you got to watch that real careful. You do not want to overpay from an implied volatility perspective, because if that vol comes down, you're going to get killed. So use that to your advantage. Try to find cheap implied vol, longer dated options to buy. Okay? And if the vols go up, and the stock goes sideways, you're still going to make a lot of money because of the Vega. All right, so I'm leaving it at that. Let me know if this makes sense to you or not. Okay? I hope this will help you kind of get a sense of what that means. There's obviously huge implications around understanding the basic concept, and so I want you to let me know whether this helps or doesn't help. Okay? So leave comments down below. If I've confused you, let me know that as well, and I'll see whether people find this interesting or not. But that's it for now, so good luck with your trading.